You're an agribusiness executive navigating an increasingly competitive market while trying to grow your company. Mergers and acquisitions are pitched as an accelerant to growth, but many M&A deals destroy more value than they create. Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches for successful mergers and acquisitions. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to another episode of the Pacesetter Pod. I'm your host, Joe Mosier, and as always, thank you for choosing to spend your time with us today. We've got a great conversation lined up for you today. I'm going to be sitting down with Dave Nemes. Dave is an owner and investor in a variety of businesses, but increasingly building a portfolio in food businesses here in Western Michigan, including a wholesale meats business, commercial bakery operations, and some other deals he's looking at. And Dave has a really interesting perspective that I wanted to get on the show. He's got more than 20 years of experience in entrepreneurship, consulting, financial analysis, accounting. He's a CPA, but he really brings a skill set of deep problem-solving expertise to a broad array of industries. He's even been retained by the FDIC multiple times in his career to help manage the process of resolving failed banks and managing all the liabilities associated with those failures. So very high complexity, high pressure, high profile transactions and issues. And he's really able to understand the numbers, understand the business, cut through the assets and liabilities, and see where is the true value. And so in his current work, he spends a lot of time helping businesses that are looking for succession or transfer of ownership, helping them with liquidity events, recapitalizations, and even sometimes helping businesses in distress, up to and including liquidation. Some of the things you're going to hear in today's conversation, and some of the reasons I'm so excited to get him on the show, is that from an outsider's perspective, so he's not a career ag guy, he's going to help you understand how investors assess the value of a business when they're evaluating the company and how they arrive at their investment decisions. He's going to talk about the unique approach that he and his investor group bring in serving as a connective tissue between ownership and the operators of the business, and how that can be done in a way that really helps the operator thrive and grow the business and look further afield than just generating near-term returns. Dave's going to talk to us about his strong preference and devotion to permanent capital and long-term investment holds. And he's going to share some views on private equity. Generally not a fan, but he's going to talk about some of the problems that he sees in the differentiation issues with multiple firms following the same PE playbook. He'll talk about the likely or expected correction of prices and multiples over time and what that might mean for the space. And he's also going to talk a little bit about the real structural challenges with forced liquidation, where you have to return the capital to investors and really forcing your hand and making you exit a business that you might otherwise want to keep. And through that, he'll also talk about some new approaches that he's working on that could be an alternate to investors that are looking to, one, be able to maintain long-term positions in food and agribusinesses, but not forego the liquidity opportunities if they need to exit that investment or exit part of that investment. So a lot here. He's whip smart. He's a good guy. I enjoyed my conversations with him, and I'm real excited to have him on the show. So with that, let's get to the interview. Dave, great to have you on the show today. Thanks for spending some time with us on the Pacesetter Pod.
Yeah, thanks for having me.
It's good to have you on the show. In full disclosure, we tried this once before, had some sound issues. This is take 2. But again, really excited to have someone with your perspective and background on the show. Dave, for our listeners, maybe just start off by giving us the 30,000-foot view on your career and background, because I think that helps folks understand how you see the world and really what experiences you bring to the table in the work that you do today.
Yeah, I can start there. So grew up in Detroit area, ended up going to school in Ohio, got an accounting finance degree from Miami University, made my way to Chicago, did public accounting for 2 years, got my CPA a little bit after that, but was CPA, decided I didn't enjoy that very much. So I decided I was going to go sleep on my buddy's couch in Breckenridge. So called my quarter life crisis, worked on the lift lines, and kind of hung out. And we started a little company doing kind of ad stuff on the internet. So came back, joined with a partner at the former firm that we did consulting, got in public-private partnerships, so a lot of loan portfolios with government entities owning part of it. That rolled into bank closures, so I got into the bank closing space and had a little expertise there, closing banks, and then after that for 10 years, up until a couple of years ago, I had expertise in managing the liabilities associated with failures. But at the same time I was working at that firm, I started a lighting company online, decided to leave the company in Chicago, moved here to Grand Rapids where I am today, to run that full time. So I had an internet company, was still flying out of Grand Rapids to DC and doing work there for the FDIC, joined a consulting firm, got into turnaround restructuring space, and did that for about 7 or 8 years. A lot of M&A transactions as well, but a lot of restructuring work. And then in 18, purchased a company, kind of still had the lighting company, stepped out of the day-to-day of that, but purchased a meat processing company. After I left the consulting world, I joined with some liquidators, and we bought some companies and unfortunately liquidated them. One of them we bought that I'm at here is a bakery that we kept that I've been part of today, and have some new partners, a family office that joined me in ownership of this company. So I still do some consulting work. I mostly look to acquire other companies and get involved in other activities like that. So.
Very good. Well, we're going to definitely come back and talk about your food holdings and
Mm-hmm.
why those survived the purge and the process of unwinding entities and distressed assets. But so just to kind of put a little more color on your experience with the FDIC and some of the bank closures, this is, I'm guessing, relatively complex work and a lot of eyes on it, but are you largely talking about a complete unwinding of the organization where it's selling off the asset portfolio in parcels to different parties, or is it facilitating transition of ownership to other banking entities and lending facilities?
Can it be all of the above? Because it's sort of my engagement initially on that. I had this weird niche where I would come in and analyze a bank that they've decided they're going to close. So we'd be the loan team and we have to figure out what we're going to do with it. So I came in about 6 weeks before a failure. At first I would just break down the data, and then I got pretty good at it. So I started writing out the plans. I was in my 20s, probably that was a lot of trust, but I was the guy that kept seeing it. So I was able to do that. And so you didn't know 6 weeks out whether you were going to sell it to someone else, whether someone was going to acquire it, or if you're just going to do a straight shutdown. Most of them were acquired through a program called Loss Share, which is what I became a specialist in later, and I helped value the liabilities associated with that for the FDIC. So I built a spreadsheet basically, and that became the check digit. So it was super random, but I helped figure out how much the FDIC may owe associated with those acquired assets. But if there was no acquirer, literally you'd walk in, figure out all the loans, figure out all the assets and sell them off, send the money back to the depositors. If they didn't come pick it up, they had 30. If they didn't pick it up in 30 days, you mailed it to their last address, a check with their money in it. So it could go a lot of different ways, depending on.
I'm guessing then this building this expertise, not by accident, but by chance, right? Maybe you were young, but doesn't mean you weren't good. But that then in turn dovetails into the work that you subsequently did, and the work you're doing now, where you do take a lot of look at distressed assets. Mm-hmm. Sometimes, unfortunately, liquidation is the path for some of those companies, but talk to us about what right now a distressed asset is coming on the market, or a company's coming on the market. You're also helping to value the component parts and create a path to what an exit looks like, whether that's liquidation, transfer of ownership, recapitalization. What are you spending your time on right now outside of your holdings?
I will tell you, it's been a journey for me. So initially as a consultant, so I would come in and figure out what that path's going to be, whether that's refinancing. So you look at it, typically you've got a non-performing entity, it's got assets, but it's got a liability problem for the most part. So you got to figure out if you can swap the liabilities, or can you swap the equity, right? Can you sell those assets off to someone else that has a clean balance sheet? So it's all that kind of interchange. So when I look at something that's, so I went from the consulting side to the purchase side in pretty hard companies that were literally only worth their assets or less than their assets. I mean, there's negative goodwill, which is a fascinating concept when you actually have to book it. You're buying assets less than their book value. So, every situation is a little dynamic, but you have to understand what is the value of that asset. So, you have short-term assets. What's the real monetizable value of it? So, what do you really get out of your AR? What can you really get out of your inventory? What can you really get out of your assets if you had to monetize it today, compared with who you owe and how you owe it to them and what their position is in a creditor waterfall, and interchange those if you want to buy it. So I went into some pretty hard situations as a consultant, and when I was doing some work with liquidators, I'm tending to shy away from the really hard stuff because I do not like the human suffering that takes place in it. If I can help someone out of it, I'm happy to do that, and I enjoy doing that. It's a weird kind of social good, I almost want to say, but like causing pain for individuals that work at a company is not something I want to be my life's work. We'll call it that.
Yeah, and I think that's something that you and I share in the conversations we've had previously over the last year or so since we come to know one another is, thankfully, in much of the work that we do in the M&A space along the ag value chain, rarely are the premiums so rich that they require draconian cuts on the back end of the transaction, nor is it typically the value proposition is we can strip out so many people and that's going to reduce the cost, and that's what makes it make sense. The synergy typically shows up in more operating efficiency, plant production capacity utilization, better ways to scalably reach a market. We don't have a problem in ag of too many people sitting around, even when you put two companies together. And so I think doing work that avoids, like you said, incurring human suffering, or at least avoiding it. Perhaps previous conditions are going to require some element of discomfort. But well, that next question I was planning to ask you was a little bit about your investment strategy. I think you answered some of that. Looking at if you're working with a non-performing asset, to use your words, they have a liability problem. You're looking at how do you actually then monetize the value of the underlying assets, and then what does that do to residual liability issues. So tell us how you ultimately then, through the course of your work, decided to actually take an ownership position into food companies, and maybe tell us a little bit more about those holdings. Because I think for our listeners, it's interesting to someone who didn't grow up in ag, who hasn't worked in food, who spent a lot of years in DC working on complex issues with the FDIC on unwinding banks. Why are you buying and running and creating value in food businesses in West Michigan?
Yeah, I mean, I will say everything I do is not distressed. I would call it a little more value, and we can get into that. But like how I got into it was I was helping someone that owned a meat production company, Tolman's, which I'm the owner of now, one of the owners, I should say, and helping them maybe find a succession plan. And it just dawned on me one day, why don't I just put together a group to do this? That's what we did. And so kind of fell backwards into it and have a love for it now. So I think there's learning through that business is that you have a barrier to entry. One reason you have, SQF and certain certifications that you can't just pop it up one day. You have an annuity stream if you treat your customers right, do the right things, that your product is always being consumed, that you produce. Therefore, you have continued revenue. It's not making, a durable product that maybe gets bought every 8 years. You have a customer base that's continuous. So I've just found that, it is an industry that you kind of have step ladders of production where you invest in capital and you get that you have a long tail to investing in capital and creating the next level of efficiency. And then that plays out and you kind of keep adding to that it's actually pretty capital efficient once you lay down the capital. And there's just a lot of good people in it. It's a small world. And I've enjoyed the people in that environment. There's less, as long as you're doing food safety is number one priority, do not mess that up. But if you're doing it, there's a lot of good relationships, and it's a lot of win-win relationships. I've seen a lot in the auto space that seems to be a lot of win-lose. And so you can just build if you're doing the right things. And in that philosophy, it's a long tail business. I mean, to get a customer, there's trust building. It takes years, and you get them, and they're sticky. And you do the right things, and you keep them close, and you build on that. So I don't know. I've really love it, and I've now talked to a lot of brands, especially through the bakery, and I'm on the manufacturing side, which I really enjoy, opposed to the brand building. That is a very tough business, even though
yes, it is.
we are purchasing a brand, but much prefer to make it than to try to sell it to everyone.
So you're, for both the bakery business as well as the meat grind and processing business, you have some private label work as well that you're doing for folks.
Yeah. I mean, very little stuff. Everything leaves with our number on it in the meat business. Very little ends up in the consumer's hands with our name on it. And then in the bakery, there's just a few items with our name on it. The most of it has other people's names, and we're very happy with that. Those they're allowed, they're able to go market, build businesses, and we're able to make and be their back of their house. And we're very comfortable in that position.
Yeah. Well, I think that's one of the things that, we talk about in the industry a lot is, despite the barriers to entry often are around, just the capital intensity of building the infrastructure. As you said, building the infrastructure, getting the right equipment, getting the right manufacturing processes in place, earning your certifications, navigating what is not an easier regulatory environment than it was 10, 20, even 30 years ago, right? It's tightening down, largely to a net benefit to society, because, safe, reliable food that people can trust putting into their mouths and the mouths of their children is pretty important for just broader social stability. But despite that, we also look at it's inelastic demand, right? People can choose to not upgrade to the latest iPhone and skip a cycle.
Yeah.
You don't really skip a cycle of breakfast with your kids, right? They're going to have to. You can, I guess, if you have to, you do. And if you could try it, I don't think you're going to have very happy, pleasant children.
Right.
But so in terms of calories, there's inelastic demand, there's repeat consumption. But as you talk about it in, this kind of annuity stream of ongoing revenue and repeat purchases and the barriers to entry, a lot of people look at certifications and food safety regs as more of a nuisance to operate. But I think it's an interesting perspective to say, well, they're actually, once you're on the other side of the moat, they make competition or potential competition think twice.
Yeah. That moat, what you're talking about, it's hard to get attacked from the bottom because the cost to get over it. And that's the bakery that we purchased was not in great shape when we purchased it. We'll just put it that way. And it had the certifications. And so, the cost to create this out of the ground is very high and the time is long. And you really can't get the customers we work with without having that. So that was kind of the base case was, okay, we're starting, if it's even at first base, at least we're on first base that we can build from, opposed to still being in the dugout, not even being able to get into the game kind of position. So that's turned out to be correct. Not without its challenges in between, but it is, you have this ability, and I like what you said there, no one's going to stop eating. I mean, if you look at it, if gasoline is the fuel for a car, we make the fuel for humans, right? We are we're an energy maker. Some of it maybe not the best energy at times, not the healthiest sometimes.
Everything in moderation.
Yes, everything in moderation. You just don't consume a lot of it. You'll be very healthy, or exercise. So yeah, we provide fuel and continuously feed that fuel. That there's no renewable source of, it is renewable, but no one's going to replace that energy source.
Yeah. So what is you're an owner of an investor group that owns these businesses, and my understanding is you're also often the face of that group or the connective tissue between that group and the chief operators that you have in place to run those businesses. But what does that relationship look like? Because as listeners here, folks that are maybe looking at a transaction, maybe interested in taking on an additional entity, but not sure if they want to actually integrate it with their current operations. I think you guys have a very interesting model for how you interact with the operators. So maybe talk to us a little bit about your philosophy, might be too heady, but just your general approach and your framework for your role between that investor group and the operator and how you enable success while also making sure that you're getting the value out of your investments that you expected.
Mm-hmm. Yeah, it's ever evolving, but I will say what I find is very functional is that on the front end, I have a lot of experience in understanding transactions and being able to do them. Yeah, but that skill is used so haphazardly that you wouldn't need that, unless we were acquiring everything. And I don't have the feeling that you have to always acquire. And so my role is really a lot of interacting with the CEOs. I like to say that I work for them at that level. I'm here to be extra support for them. Sometimes the face to customers, but mostly it's their companies to operate, and I'm here to support them. And then with the investor group to kind of carry that communication. And then if there's major issues, get involved, financing, get pretty involved in that. We've purchased a building for the meat company, so very engaged in that process. So kind of those challenges that pop up that need some support, I'm there for that. And so I kind of play a role in and out, have, email addresses at each, but try to stay out of the way, but be additive support. So very much I work for the CEOs. They do the right things, and I help support them.
So I think about it in terms of the context you talked about working out and exercising a moment ago, but almost the spotter, particularly from a finance side. I'm guessing that's where you bring the most immediate expertise to the table. Financing, CapEx strategy, M&A, evaluating opportunities, et cetera.
Yeah.
Do you or others in your group get involved in sort of the commercial strategy side of the business, or more act as a sounding board to the strategies that are being developed by the CEO and that executive team?
Yeah, I wouldn't say we have clear delineation of lines. There's certain stuff that, certain opportunities that will just kind of ring on my phone. Some people connecting the dots that I know in the market. So sometimes I become the lead, but I'll call it a little more of a Trapper Skinner type role on those opportunities where I'm kind of engaged at the front. But for me to be like, all right, this is what we're going to do for you, all of these steps, it's unfair to the company. So I do engage in that. We talk through at the bakery, we kind of have an opportunities list, and I go to that meeting. We talk through kind of what's out there, and I'll be assigned tasks off that. But it's really the team there is the face to, the day-to-day face to the customers and engaging that commercial, and their vision on what's going to happen is more important than what if I were to tell them what to do. So really an additive to that commercial strategy, but definitely not, here's the playbook, take this playbook, apply it without question.
Very good. Which is, so since you mentioned playbook,
Yeah.
that's the other thing that we definitely wanted to talk about today is, this is, I'm not going to say it's unique in terms of it's not replicated elsewhere, but it's not common. The approach that I've witnessed from my perspective and my network and the folks that I interact with, your approach is a bit different, right? It's
I'm learning that.
You're not hyper local because you're not bound to just Western Michigan. I know you do look at deals further afield, and you can support from a consulting perspective, darn near anywhere.
Mm-hmm.
But your long-term, perhaps even permanent capital approach, where you put money into the business, and it's you're not immediately then looking at what is the exit horizon. It is, some people listening may have said, well, is this guy a private equity investor, right? And so let's talk about that. Let's talk about kind of how you see yourself different from private equity. I know you've got some strong opinions on PE.
Mm-hmm.
So let's just let's go there. How are you different than private equity? And then through that, what's your general view on the private equity space?
Yeah, and it's still evolving, but I would say some of what the thinking comes out of is a lot of learning, but a little bit of inversion of what I saw private equity doing and what I may have seen wrong with it and to avoid. And so one of those base cases is sort of the speculative nature of private equity, meaning buying something then attempting to trade it in this finite time frame to someone else for greater money. Whether that means, that's kind of a blanket statement. Someone could really improve a business and do it in that time frame and be right to sell it because it may have the next stage of growth. But as a blanket statement, it feels like it's a very forced template. And I tend to think creatively or attempt to. and not go with forced templates. So I've really landed on the idea of long-term holds, the beauty of compounding value, meaning you're getting the same idea as compounding interest, but your value is increasing every year if you're doing the right things. And why would you monetize that? It seems extremely speculative to try to monetize it, then find something else to put it into to attempt to do that again when you already had something that you understand, that is hopefully producing value. Why not stick with that and do that over and over? I still haven't landed on the complete right structure to create, as a friend of mine's part of a tugboat institute that's a 100-year company. That's what they stand for or try to preach. But how do you create this? If you look at another inversion of private equity, they sell because they want to get their investors' cash back. And the idea I'm playing with now is, how do you, instead of creating trauma inside a company to sell it, what if you just swapped out the investors? So you create monetary events for them, or create liquidity through even, I think the public market is a beautiful model, but it's so skewed with regulatory that it makes it not appealing. But that ability to create instant liquidity, if someone so chooses, is a great model, because now the company doesn't have to worry about who owns it getting money. It has to worry about who wants to own it. And it can continue to exist without the trauma of a sale, changing parties, layoffs, as we talked before, that all of those real humanistic aspects that are noise to a business, opposed to letting it be what it is and letting it continue to be what it is.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
So say more. That's interesting. The trauma of the transaction. So let's use an example of, you've got a family that develops a unique and novel solution that's, requires some manufacturing, a little bit of tech, and it solves a problem, let's say, in the field.
Mm-hmm.
These are farmers or working with farmer communities. Yeah. You got the families involved, the kids are involved, maybe a couple of employees. It's a good business, but they need capital. Mm-hmm. Basically need a capital infusion to grow. And maybe they're not entirely sure how long they want to be in it, right? People age and et cetera. So that initial transaction, when they sell to a private equity firm, in many cases is kind of a relief, right? Because it provides, don't mean to be derisive anyways, but people say it provides some adult supervision. You get some folks with professional management experience that come in that have processes and systems that create rigor, but they also do actually lighten the load, right? Because they look at how do you optimize your back office, and suddenly payables and receivables and invoicing and inventory management kind of becomes a little bit less arduous. Yeah. So that initial transaction is often a relief. But you're talking about trauma. What's the trauma in that one? Or is it really trauma in that subsequent transaction? Because the challenge is these folks sell. Maybe they're still in the business with some minority ownership. Yeah. But it's the secondary transaction that's also now they've lit the fuse. The clock is ticking, because that's that the PE firm's not going to hold them forever. Yeah, and I think that example is tough to argue against, because quite frankly, I had that conversation last night at my house with someone that was in town, and I was like, you need someone like that to help your business, just because you've grown to this point, but there's not enough infrastructure around you. And if you can get infrastructure around you, it allows you to focus on the things you need to. And so I don't see that as traumatic, but it's then the normal course after that of continuously being traded, that someone takes their own viewpoint or tries to slam something together, gets rid of jobs, takes on a new strategy, all of those things. There's human beings underneath all of that, and there's trust that has to be built, and that trust takes a while to be built. And once you start trusting someone and then they're like, see you later, it's dramatic. It's like a breakup. And I think there is tremendous value if that scenario that you played out, I mean, how I would think of that is find a partner that's a long-term partner. The family in that situation should, not
risk all of it for the long term, but get someone in that you could partner with. I mean, oftentimes people think of a transaction as truly binary. Either I buy it and own it, or they keep it, right? And there's an infinite amount of numbers between 0 and 1 in a binary world, that you could formulate the right transaction that says, okay, we're going to take enough chips off the table that we're safe. We've got a partner now that allows us to grow with capital. But why do we have to focus on the next exit? Why don't we focus on, just building an awesome company, and then we can evaluate each of those situations as they come about if we have someone asking about a liquidity event, rather than forcing a time frame in which you have to have a liquidity event. Just continuously being very functional, and actually, instead of having a rigid playbook, just be an investor, understand the ebbs and flows, and understand that you built something. Why not keep it? Why sell it? Why get the cash now? It's the difference between rich and wealthy, in my opinion. Rich is an activity of trying to get money in the near term and then pocketing it. Wealthy is creating something of value over time, or having a steady stream of like cash coming in. And that's the difference between building a condo building or apartment building, right? Apartment building, you sell it all off, you make your last 10%, you make your money. In an apartment building, you hopefully build it and are able to just have the stream of cash flow that has value over time and continuously pays you.
Yeah, that's always been a challenge. On this show, we've had now a number of guests come on and talk about private equity. And I think it was important. Folks that represent or are owned by private equity and have experience in private equity, it's not a monolith.
Mm-hmm.
And there's a spectrum of actors, and there's a spectrum of objectives and approaches. And we had some folks on that I have a lot of respect for, and I think they do their work really, really well. But one of the challenges for me has always been what I just call like the investment horizon problem. Mm-hmm. And it's like you said, it is a structural constraint on the model, or structural requirement, where investors in the pool, those LPs or limited partners, they have put cash in knowing that cash comes out. Yeah. Right. And so it ultimately results in many times, I won't debate whether or not PE beats the market. That's a whole separate discussion. But it forces you to exit businesses that you may well want to own. And I think that is a seemingly unsolvable problem until someone like you comes along and says, well, wait a minute, what if there's other ways where folks didn't have to have the cash back, but they had the option for liquidity?
Yes.
Because that's threading the needle.
Yes.
Right? You've got the public markets, highly regulated, analysis is commoditized. You can take a short position against a company, you could build a long-term position, whatever you want to do. And you have high liquidity, but it's very hard to differentiate your returns.
Yes.
And then private equity, you can make some really big bets. You may outperform, but as you said, you're going to be forced to, you might have to take your money out of the company when you'd rather just say, you know what, this is the best opportunity. Our best option is to not remove cash, and yet you might have to.
Yeah.
So I don't know what my question is there other than a soapbox. Yeah. It's just that is a structural challenge, and I appreciate the fact that folks like you are looking at and saying, is there a way we could solve for that?
It seems like a society we've gone to. I don't want to put everyone in the same box, but it's almost like a get-rich-quick scheme. How quickly can we do this? A lot of search funders that I speak with, it's like, I'm going to buy this, get rich, and then I'm good. And you're like, why don't you buy it and build something that matters and be an owner? Like, have your blood in the bricks, and then figure out, maybe if you don't want to operate it day-to-day, find someone else to do it, but still own it. And it almost feels like as a society we've moved to that. And I'll blame business school as teaching private equity, is everyone has the same playbook and comes out with it and says, I must do this and I'll have this box that I must fit in. And same with search funders, that's just private equity at a smaller level. And it's almost like as a society, bond investing opposed to stock investing. Not a lot of people think about bond investing. And that used to be a very, very in vogue thing. And then suddenly it kind of became sort of this thing in the ethos that bond investing was, could I buy something that paid me 8% a year? I give it 8%, it's secured, I get it back at the end. Pretty great. Mm-hmm. And suddenly we all decided we wanted 20% returns on hot things, that we were going to get a huge return in 4 or 5 years, and then we'd be rich. And if it was good enough back then for bond investing and holding things and compounding, if say you got 8%, you put it back in, over 9 years or whatever it is, you double your money. That's pretty awesome. And you'd still have, and your principal is not really at risk. But we tend to now want to put our principal at risk, see it go way up real quick. And if not, though, that the flip side of that is you increase the risk and it can go to zero. And for me, like the idea of having capital losses, I don't gamble because I hate losing principal. It's just too hard to do to recover from a principal loss. So how can you create an environment where you have a long-term hold, where it's not speculative trading, and it's about building bricks that continue to create wealth in the long run?
So I think fundamentally one of the challenges as well with private equity is, the differentiation problem. And you talked for a moment there about all the business schools teaching the playbook, right? And there's even a book out there called the PE Playbook.
Yes.
And the gentleman's written a number of other books as well. And I've heard him on a number of podcasts. He's really interesting to listen to, and he's had some great results.
Yeah.
But there is a certain differentiation problem when you start to commoditize the playbook, and everyone's learning the same sort of frameworks and processes, et cetera. And then how do you is there really that much? I guess the question always is there really that much captive value locked up in companies that if you just simply apply the playbook, it works every time? And I think it doesn't. Right, because companies are not created equal. And the other thing is the playbook works great in a market where there's a secular curve up and to the right.
Mm-hmm.
And, we've had a tremendous bull run.
Yeah.
And if you even normalize for the last 3-4 years with COVID, we're still ripping.
Mm-hmm.
Right. But that doesn't last forever. So, I mean, do you see the differentiation problem showing up where you actually see people competing for deals and they don't offer any sort of unique differentiated value other than we have access to capital and we're really good at turning the thumb screws and we'll drive costs down before we exit?
So I think the initial part of that is, do you create that? Is there value to be created? Yeah, there probably is on a lot of levels with a lot of companies that are just kind of inefficient due to either just not knowing the world or just that's how they always did it. But I think then it's a matter of what you pay for it, right? It's not as simplistic as, can you unlock some value? If you overpay for the value you attempt to unlock, and I think that's what you're seeing it's that playbook is creating competition. And if you do what everyone else is doing, it's a regression to the mean, meaning over the longest term, you will go to the mean because how do you outperform someone who has the same playbook as you? It's illogical. So it's becoming more and more difficult, at least what I see, and it has to become more financial engineering rather than operational improvements and business improvement to create value. So you got to financially engineer, how do you rip all the cash out of it? I mean, some of the stories I've seen or heard, just kind of the way they debt finance and stuff is like, wow, that's like craziness. That doesn't make sense if you really own this company, only if you're vulturing it. And so they have to get more complex. At some point, that hot potato is you can't trade it to someone else because they have the same playbook and it's just not going to match the math. And also, not to go too far on this point, but we're in a credit cycle. And if you've ever looked at any of the Minsky stuff, you have this up cycle where it keeps going well and more credit gets extended and you go up. But at some point, it's the Minsky moment when it flips to the down cycle of credit, which we haven't seen a true down cycle in credit since the financial crisis of 2008 through 10. We haven't seen that retraction in credit, maybe in micro markets and things like that. But you're starting to see the cracks in office and things like that, which starts to do the flip over here, and people start pulling back credit. And it's happening a little bit on the fringes. But when that happens, that allows for that capital, because you can only use credit or cash to buy things. That contracts what the next person can do to buy it. So your flip's not there because there's no credit. And that down cycle, I mean, we've seen, it's probably 14 years on an up cycle of credit markets. We haven't seen a downturn. And they usually last, I think the longest was like 11 years, and COVID screwed that up. We're coming to the end, I think. But the 2-year down cycle, which is typical, is pretty nasty. And so with how much has gone into that market, how much valuations have gone from, 6 is the new 4, 8 is the new 6, and 12 is the new 8 multiples, I don't see how you get out of that trade if you bought it at 12 and have debt on it, that interest has gone up. I don't see how you get out of that trade, especially if you're in a down credit market.
Yeah. So let me restate that to make sure I'm following. So we always look at that and think about in terms of the structural PE pricing problem, where I don't have data on this, but it feels like a lot of PE exits are often then traded with other PE investor pools.
Yeah.
Right. And I know the latest information I did see was that 30% of all middle market transactions in the US have at least one PE party involved. And I feel like that just feels low, because I don't see how the balance of the 70%, they're not all public market companies buying these middle market companies. They're not reverse mergers,
right,
where a private's buying a public. And I don't necessarily think that 70% could be consumed by just private owners consolidating in this space, right? But the data is what it is. So let's call it 30%. But those folks, so they've now got the same playbook with the same general investment harvest timeframes, exit timeframes, and they're all looking to trade up. Mm-hmm. So there is some logical, in my mind, there must be some kind of logical ceiling at which point the market corrects and say, well, there's not an up trade to be made.
Yep.
Right. When you sell this thing, the best thing you do is probably get out with what you have in it, but because no one's going to pay a premium over what you have invested. And when that converges with a down credit cycle, so in many ways, the availability of credit fuels the ability to trade up.
Yep.
Because the hurdle to make a return is lower, because your cost of capital is lower. So it's the convergence of that down credit cycle with a frothy, maybe already at the top of the pricing trade. When that happens, but when that happens, what does that look like, Dave?
That's a really good question. Dissecting some of those points, like if you buy an antique or a collectible, you want to make sure you're not the last person that thinks it's worth that, because then you're stuck with it. And it's sort of that, like, so you've driven up to these valuations. There's less money that's going to underwrite for those type of valuations, and the low cost of funds, the zero interest rate market, caused those values to go up. And then also you had money flowing into those markets that had to be used. So, well, if the market multiple for this is 10 now, because everyone else buying at 10 because they had to get a deal, well, then I got to pay 10. So you have this inflation. It's almost great inflation. And so what happens there is it depends on, if you're buying on cash flow and not assets, like there's nothing to fall back on. And if the cash flow becomes less valuable, I mean, you see it in downtown office, right? Everyone's kind of, knows that market is heading toward a bloodbath. And you look at the refinancing of that, and it's a great example for it because it's run on cap rates, and say cap rates were 5%, 6% on really grade A stuff, and now they're at 8%, and then you have a rent roll that's down on a downtown office. Well, the valuation metrics, those are the two drivers of that metric. And that valuation of that office went way down. And you bought up here, you have 5-7 year note, you go to refinance, your LTV is below what's acceptable by the bank. And someone's going to carry the bag because they cannot finance it. They cannot due to the new metrics. And so you're stuck without being able to repay your debt because it's callable at that point. You can extend and pretend as a bank, but you're sitting with what is presumed to be collateral less than your loan value. And I don't know what you do. Someone's going to carry the bag. Likely you're going to see foreclosures. That's not the right term for a business, but you're going to see handing over the keys. Bankruptcy may be an option, but likely just sales. Because these are almost, a lot of them too, don't have recourse, right? And we saw that in the housing market where you had non-recourse loans. People just handed them back to lenders and said, I'm out. And I think you're going to see more of that. And it's whether these rolled up duct tape companies that maybe are a bunch of acquisitions into a final kind of bought by a PE, whether you see those disbanded, whether you see just equipment hit the market, but there's going to be bloodletting, and there's going to be principal losses, because unless you invest more to create more value, the lender becomes in the first position, and they'll take the keys and they'll extract the value to get paid back, and that means equity's gone. That's the right side of the balance sheet. You got the left side of the balance sheet being assets, and if your cash flow has some value that adds on top of that asset, maybe. But if that's not greater than your liability side, then your equity down here is worth nothing.
Yep.
And I think you'll see a lot of that play out.
All right. So you heard it here, folks. Bloodletting in the market, timing TBD.
TBD. Right? I mean, I gave a presentation in 2019 on the mathematics of exactly what I'm talking about to ACG here in town, and a little debate format. And I thought it would happen sooner, but it didn't. And I just think there's a powder keg waiting to happen. And it's not just in the PE world. It's also SBA financing, a lot of search funds. There is I've looked under the hood of a lot of these, and there's no way to get out of it. The SBA is full recourse debt to individuals, and they'll garnish your wages and taxes. And there's people that put 10% down on companies, and the cash flow is adjusted EBITDA, and those adjustments never saw them what they're supposed to be. There's no cash flow there. They've got these long tail loans that are going to hang over them, and they're kind of zombies where all they're going to do is exist to pay off debt, or else it's complete disaster for the owner. And it's crushing to watch from a humanistic. You have someone thinking about getting rich, and that's why they did it. And the flip side of that, they never thought about the flip side of making them truly poor.
Yep.
And
going to zero.
Yeah. And I saw someone who put 300,000 in, we'll call it, somewhere around there, maybe 4, and they're on the hook for like $2 million now. Of upside down. And you're like, that 400,000 cost you a lot more. So it's a lot more about not picking winners too. When I look at stuff, it's about not picking losers that can put you in that position. Because I never want to be in that position.
Very good. Well, on this incredibly bright note, we'll bring it to a close. I will say, just to the listeners, Dave is a serial optimist.
Yes.
And I think you have to be to do the work that he does. And so, but we also want to make sure we did talk about this and provide a somewhat different perspective on this and some of the structural challenges and maybe cyclical challenges that are ahead. So, Dave, for folks that like what they hear, maybe they want to understand a bit more about your approach. Mm-hmm. Maybe they have a company that they are looking to exit. Maybe they have a company that they're looking for options. How do folks get in touch with you?
You can find me. You can find my website, Business Code App is my entity's business company, LLC. LinkedIn, David Nemes, and just connect. Always interested in learning about businesses. Love to find some great operating companies. Again, not totally distressed, but bringing in the right capital, partnering with the right people, and doing great things. That all aligns with that strategy. And I like to say, on the point of the optimist, I like to say I'm an optimist that looks through pessimistic lenses. So I can cover the risks of what could go wrong and make sure those don't happen. And if you don't do that, then you have a greater ability to success. So anyone that likes that philosophy, I'd love to talk to you too.
Yeah. Manage your risk, don't run from it, right? So
yes, always
understand and manage. But,
yes.
Well, Dave, thanks again for being part of the Pacesetter Pod today. And thanks, as always, to our listeners for tuning in. Remember, you can like and subscribe to the Pacesetter Pod wherever you get your podcasts. And you can also find me, Joe Mosier, on LinkedIn, where we can connect. And if you'd like, you can set up a call with me directly on our website, mosiercg.com. Thanks for listening. Have a safe day.
This is the podcastfactory.com.